This is July 28th, 2026, and Ethereum just received a better institutional ownership vehicle, and price sold off anyway. Morgan Stanley added the Morgan Stanley Ethereum Trust, ticker MSSE, to its digital asset product lineup. Its prospectus allows the trust to reflect staking rewards when legal, regulatory, and tax conditions permit. At the same time, more than 2.4 million ETH is waiting to enter staking. Only a few hundred ETH is waiting to leave. Yet, Ethereum pushed towards 1,978, failed to hold the move, and fell back below 1,900. Ethereum became easier for institutions to own. Demand to stake it became stronger. Spot demand still failed to deliver a breakout. That disconnect is the entire story this week. Ethereum's investable structure strengthened this week, but spot demand failed to confirm the improvement. Long-duration participants are committing more ETH to the network. Short-duration capital remains cautious near resistance. Until those two time horizons align, Ethereum's investment case can improve without its market trend improving with it. Ethereum entered the reporting window near $1,930. It moved above $1,950, weakened towards the mid-1800s, and then recovered sharply on July 26th. That recovery carried ETH to nearly 1978 before the market reversed and returned below 1900. The full weekly range extended from approximately $1,848 to $1,978. That gives us two important zones. The area between roughly 1950 and 1980 is near-term resistance. Ethereum challenged that region more than once and failed to establish acceptance above it. The 2000 level now sits directly above the rejection. A brief move through it will not be enough. ETH needs to reclaim the recent high, hold above 2,000, and attract enough spot participation to prevent another immediate reversal. On the downside, approximately 1,848 to 1,870 is the immediate support region. Ethereum has not confirmed a breakout beneath that floor, but it has also failed to build sustained momentum away from it. The chart remains recoverable, but unconfirmed. The strongest positioning signal this week came from staking. Validator Q data shows more than 41 million ETH already staked, with another 2.44 million ETH waiting to enter the validator set. At the current processing rate, that represents a wait of more than 42 days. The exit queue, by comparison, contains only around 480 ETH. That imbalance is significant. Participants are willing to wait more than a month to begin earning Ethereum's native staking yield, while existing validators are showing very little urgency to leave. But the queue should not be treated as entirely new investment capital. Some of it may reflect validator consolidation, operational changes, staking providers repositioning inventory, or ETH that was already intended for long-term use. It also does not guarantee an immediate supply squeeze. Staked ETH can remain economically active through liquid staking tokens and other structures. Even with those qualifications, the direction is constructive. Far more ETH is waiting to become committed to validation than is waiting to leave it. Glassnode's transfer band data showed a different short-term signal. Smaller transfer cohorts were net withdrawers from exchanges, while transfers above 10 million produced roughly 54,000 ETH in net exchange inflows near the local high. That does not prove large holders sold. Exchange deposits can support hedging, collateral, custody transfers, market making, or eventual sales. But the contrast matters. The staking queue reflects long duration commitment. The largest transfers reflect short duration caution. Ethereum's positioning is divided by time horizon. The most important institutional development came from Morgan Stanley. The firm now lists the Morgan Stanley Ethereum Trust, MSSE, within its digital asset product lineup. According to the prospectus, the trust is designed to reflect Ether's price and may incorporate rewards from staking part of its holdings when the delegated sponsor determines that staking can occur without unacceptable legal, regulatory, or tax risk. That gives regulated investors a more complete version of the ETH investment case. Ethereum is not only an asset with price exposure, it is also the working collateral of a proof-of-stake network capable of producing protocol rewards. Placing these two elements inside one investment vehicle improves access. It does not prove adoption. The trust is new, but we do not have yet enough evidence of meaningful assets, sustained share creations, or how much ETH will actually be staked. Staking is discretionary rather than guaranteed, and product listing does not establish universal availability across every Morgan Stanley client or account. The conclusion must therefore remain precise. Morgan Stanley has created a better route into Ethereum. Assets under management, share creations, accumulated ETH, and staking participation will tell us whether capital actually uses it. The route now exists. The demand still has to appear. There was no major base layer catalyst during the reporting window. Ethereum's investment case improved through distribution and staking, not through a new protocol upgrade. Application layer security, however, delivered a warning. CoinDesk reported that several bridges and cross-chain systems lost more than 35 million in roughly 6 hours. Those were application layer failures involving contract logic, permissions, validation, or upgrade authority, not a compromise of Ethereum's underlying cryptography. That distinction matters for institutions. A reliable base layer does not remove the need to evaluate smart contract design, custody architecture, administrative controls, key management, and bridge security. Institutional confidence in Ethereum does not automatically extend to every product built around it. Derivatives added another source of risk. Aggregate market trackers placed ETH open interest near 27.7 billion on July 27th. That shows substantial positioning, but not its direction. That total can include speculative longs, shorts, hedges, basis trades, and market-neutral strategies. What matters is the elevated leverage can accelerate price without creating a durable trend. Ethereum rallied into resistance, but spot participation did not keep the move together. Leverage can amplify expansion. It cannot replace sustained spot accumulation. Ethereum now needs to convert structural improvement into measurable demand. The first confirmation will come from MSSE. Watch whether the product begins reporting meaningful assets, sustained share creations, ETH accumulation, and actual staking participation. Access becomes demand when the vehicle begins absorbing ETH. The second confirmation comes from the validator queues. If more than 2 million ETH continues waiting to enter while exits remain minimal, Ethereum's long-duration positioning stays constructive. If the entry queue collapses while withdrawals begin building, the signal weakens. The critical issue is not one daily snapshot, it is whether the imbalance persists. The third confirmation comes from price and spot participation. Ethereum needs to reclaim the recent high near $1,978 and establish acceptance above 2,000. That move should be supported by real spot volume rather than a temporary increase in leverage. Another rejection would show that sellers remain willing to use strength as an opportunity to reposition. On the downside, a decisive loss of approximately 1,848 would damage the recovery, especially if it arrived alongside rising exchange deposits, a shrinking entry queue, or growing validator exits. The immediate outside catalyst is the Federal Reserve. The July meeting concludes on July 29th with the policy decision and press conference capable of repricing risks assets across the market. A supportive reaction could give ETH another attempt at 2,000. A restrictive reaction could test how much support actually exists near the weekly floor. Ethereum therefore needs alignment, better institutional access, persistent staking commitment, stronger spot demand, price above resistance, and a macro environment that allows the move to survive. Ethereum's investment case got better this week. Market's bid did not. The next expansion begins when those two finally move together. Now, Ethereum cannot be understood through price alone. Staking, institutional products, capital flows, market structure, security, and macro conditions all shape how the asset behaves. That right there is exactly the framework I break down in Understanding Crypto, a clear guide for new investors. The link is in the description. Ethereum became easier for institutions to own and more attractive to stake. Spot demand still failed to confirm the improvement. Now the market has to show us which side matters more. Tell me which side you're watching most closely. Morgan Stanley's product growth, the staking queue, or Ethereum's next attempt to reclaim 2,000. And subscribe to CoinOps for disciplined crypto analysis without the hype. Stay locked.